The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick. Ben Boulos is next to me here in London, but Charlotte Reid is at a key meeting of Western leaders, finance leaders that is, in Paris. And these are your headlines. A rout in global bonds deepens, heaping more pressure on stocks. The 10-year Treasury yields in the United States jumping to their highest level in 15 months on persistent fears of inflation.
And the sell-off is set to be a key topic of discussion for the G7 finance minister and central bank governors meeting here today in Paris. French Finance Minister Roland Lescure addresses the scale of the global challenge.
Multilateralism works, that it's useful at a time of crisis, at a time where global imbalances are suddenly unsustainable, at a time where raw materials and critical minerals have become critical in the supply chains of the world.
Crude prices are on the rise again. President Trump issuing a fresh warning to Iran over peace talks, saying the clock is ticking. Ryanair CFO Neil Sorahan raises the prospect of airline failures amid rising jet fuel costs. But speaking to CNBC, the airline's finance chief pushes back on the likelihood of more dramatic scenarios this summer.
Do we have plans for some kind of an Armageddon situation? Of course we do, but I don't see that coming to pass. I'm less concerned than I was. That said, who knows what may or may not happen.
Very warm welcome to the show. Hope you had a lovely weekend, a restful weekend, because you've got another busy week, haven't you? Because the president, Mr. Trump, has warned the clock is ticking for Iran as the impasse in negotiations to end the conflict continues. According to Axios, the US leader held talks with Vice President J.D. Vance, Special Envoy Steve Witkoff, and Secretary of State Marco Rubio over the weekend, and will hold a Situation Room meeting tomorrow to discuss military options. Dan joins us now out of the Middle East. Dan, seemingly more of the same, but of course closer to home for you as well. This attack on the nuclear facility, again worrying everybody in the region.
That's exactly right, Steve. And that drone hit near the UAE's Barakah nuclear power plant on Sunday. UAE defense officials said air defenses engaged 3 drones, in fact, that were fired across the country's western border. They were able to down 2, but the 3rd drone seemingly got through, causing a fire at an electrical generator outside the inner perimeter of the plant, not the actual plant itself, just inside the general vicinity. Now, this is located about 175 miles west of Abu Dhabi, so it's well away from residential and commercial areas. The UAE Foreign Minister Sheikh Abdullah bin Zayed holding a phone call with the IAEA Director General Rafael Grossi shortly after the incident. An official statement said the minister condemned what he called a treacherous terrorist attack at the site, but also informed the Director General that there were no casualties and no impact on radiation safety levels. And of course, that's the most important element to this. It's understood now that all 4 reactors there, which supply about 25% of the UAE's power needs, continue to operate as normal. However, the IAEA did say 1 reactor is now running on emergency diesel generator power following that strike. What's also interesting is that the UAE has not directly accused Iran here as well, but the diplomatic advisor, Dr. Anwar Gargash, really made the implication pretty clear, writing on X that the attack represented a dangerous escalation and a dark development, he said, that violates all international laws and norms. Iranian state media had previously listed Barakah, the plant, among Iran's potential retaliation targets as well. That is, of course, after we saw President Trump threatening back in March to obliterate Iran's power plants if Tehran didn't lift its chokehold in the Strait of Hormuz. Now, of course, President Trump didn't follow through on that threat. But at the same time, the US and Israel have carried out some pretty widespread strikes on Iranian nuclear sites throughout this conflict, including the attacks close to Iran's Bushehr reactor. And of course, Iran, which is backed by Russia, has repeatedly called for international condemnation of those strikes on nuclear facilities. And then, as you mentioned as well, President Trump posting on Truth Social saying for Iran, the clock is ticking and they better get moving fast or there won't be anything left of them. He is expected to convene that national security team in the Situation Room on Tuesday to discuss potential military options if the diplomatic track continues to stall. It's back over to you.
All right, superb coverage as ever. Thank you very much indeed for that, Dan. Right, in the meantime, Ben, let's take a look at these 10-year yields, because here's a question for our viewers. Are they going up because of concerns about wars and inflation and interest rates? Or are they going up because we've had the seeds of a bond, not so much crisis, but a bond sell-off, or certainly a lessening in the value of bonds, that have been actually germinating for a very long time? Because I would argue, as I have tried to argue for years as well, that the levels of global debt, Ben, are actually more the key determinant rather than the catalyst that we're seeing here and now.
Yeah, it's a very good point, especially when the US deficit is projected to run at around 6% for the coming years each year, adding to the total debt pile. Investors clearly nervous, whether that's the reasons of the growing piles of debt or the inflation fears because of the oil price, the energy price spike. But the result of whatever the motivations are clear to see. Look at this. Across the board, we have seen the 10-year yields on various sovereign debt rising towards the end of last week, particularly the Japanese one. That's levels not seen for many, many years indeed. The UK one just easing off slightly, but that really spiked last week over the political turmoil and the uncertainty about what it could mean for the UK's fiscal position and fiscal discipline. So those are the 10-year yields. But interestingly, we also saw on the longer dated debt a jump in the yields as well. Remember, these yields move inversely to prices, so it's reflecting investor nervousness about the longer term outlook when it comes to inflation and economic prospects. So we're going to detail on those, but it gives you the sense, the short end, the long end, we're seeing rates rise. And it's worth remembering, this is without central banks yet hiking rates for the most part. The European Central Bank, the Bank of England, the Federal Reserve. This is happening despite that. And there are also reports that we're starting to see it filter through into mortgage costs for consumers in the US and Europe. So there's a very, very immediate real-world impact on household budgets. The impact of that, of course, could be felt on consumer spending in the medium term. So that's the bond situation. Let's have a look at the equity markets. And this is how the US markets, the main benchmarks, closed on Friday, wallowing in a sea of red after a week in which fresh record and intraday highs were hit, particularly on the tech-heavy NASDAQ. It's really been tech that's powered the rally. But even that, giving up the most territory of the three main benchmarks. That was the picture on Friday. Let's have a quick look at what's happening in the Asian markets right now. This is in the current session, and the Kospi, the only one of the main ones of the four on there that's in positive territory. But that's quite a turnaround. In the early part of the session, it had fallen so sharply that a halt to trading was triggered as a sort of safety mechanism. But look, it's recovered and pushing up into positive territory there. The other main benchmarks off by various amounts. Let's have a look at what's being anticipated when European trading gets underway for the new week, and a negative start being called tracking those losses in Asia. And let's quickly cast an eye stateside because we've got one of our guests waiting in the wings. But this, again, look at that, a negative start to the trading week being anticipated as we expect the three main benchmarks in the US to open lower. Esther George, former president and CEO of the Federal Reserve Bank of Kansas City, gave her outlook on US bond yields, which we were mentioning a moment ago, amid inflationary pressures.
The whole credibility of this institution, I think, depends on achieving its mandate. And its mandate is low and stable inflation, which they've defined as 2%. So when you go on now a sixth year of seeing inflation run hot, and again, for reasons they couldn't have anticipated, they have to be very attentive to that. And I think you already hear some of that in the most recent meeting they had in April. The 2-year bond yields are beginning to go higher. What I think is the market looking for, again, the Federal Reserve to be very sure about its willingness to bring that inflation down.
Oh, so many questions for Kieran Ganesh, who is multi-asset strategist at UBS GWM. Very good day to you, sir. Thank you very much indeed for joining us. Look, I don't know, do you want to weigh in on the bond market at the moment? Given everything we're seeing, given everything that Ben's just said, and given my longer-term concerns about the fiscal reliability of banks, of governments not reined in by central banks and reined in by the bond market, are actually companies a better bet now than bonds for your safety trade?
Well, I think the trouble with companies is that the bonds are also issued in currencies. So, we really do think that the governments are still going to be the benchmark in a given currency. So, for example, US Treasuries are still going to be safer than any company bonds issued in US dollars. But I think the broader point that markets are going to get tested by high yields in the coming weeks, I think, is valid. As you mentioned, we have got elevated supply due to some of those elevated government deficits, and demand could be a bit shaky amid fears of inflation and ongoing high oil prices.
And yet, Kieran, and I'll challenge you using your own logic as well, if I may, a very interesting piece talking about selective moves you make in European earnings, the momentum carrying on as well. But you mentioned that cost discipline is helping boost earnings even though revenue growth remains weak. Cost discipline. We see cost discipline at companies, but we don't see it at governments.
Yes, well, I think that's part of the dichotomy we're seeing at the moment in the market generally, is that we've got this sort of apparent sort of weakness and concerns from geopolitics to governments to the sort of growth level. But markets are just doing very well. And I think that's the importance of focusing on those company specifics. Earnings growing close to 20% in the US, close to 10% in Europe, more than 50% in Asia. And I think that's part of what's kept the markets going, and despite some of the headline concerns in recent weeks.
I was looking beyond the two big trends at the moment, one being based on geopolitics and the other one being based on AI. If I was worried about the latter and the former, where would I go shopping, Kieran? Where do our viewers and your clients look beyond the AI thematic and look beyond the energy price spikes, which are creating problems for all kinds of companies and all kinds of supply chains?
Yeah, well, it's tricky if you're worried about both, because the equities are, quite driven by the AI trade. And then if you're concerned about the oil price, then that can also weigh on the bond markets. When we're looking at hedging, it's parts of periods when you have got lower volatility is, a good time to just put in place explicit hedging on equity markets. We've had some of those periods in recent weeks, and we've been encouraging clients to think about building up explicit hedges during those periods. And then we think that commodities themselves are actually quite a decent hedge if you're concerned about both AI and the crisis in the Middle East. Of course, commodities are likely to rise if we do have further supply disruptions in the Middle East. But then they are, also exposed to, the energy demand that's coming from AI, and we think that there's still structural support there. So as a portfolio diversifier, that's something we've been quite focused on this year, and it has been adding value to portfolios.
Kieran, I was looking through your latest note, and some really interesting observations on the European earnings and the momentum that you're seeing improve. Just talk me through the point that is in there about the way we've seen more companies beat on earnings than on revenue, and what that tells us about the consecutive the quarters that lie ahead and how they may perform in those.
Yeah, I think that the bigger picture for European companies is they've had a number of years of pretty weak revenue growth. Now, this year, it's still been a bit disappointing, but it is starting to come through. But what those many years of weak earnings growth have taught European companies is that they need to be disciplined on costs. They need to build up some operating leverage if they're going to grow earnings at some point in the future. So we think that through this year and next year, that's actually where some of that's going to start to bear fruit. It's been really encouraging to see that coming through already in this earnings season, that you have started to see some of that cost discipline leading through into earnings growth. And we think that if and when we do see the proper inflection in revenue growth for Europe, then you could see quite substantial earnings growth going forward. So for Europe, it's not so much the story of earnings growth today. That story is very much in the US and in Asia. But we do think that there is potential for stronger growth in future if this trend continues.
Another interesting line from it, and I'm not sure whether this came from you specifically or one of your colleagues, but I'm interested to get your thoughts on it. It says in this UBS note, expect the Federal Reserve will ease policy towards the end of the year. Is that really a feasible option, given the hotter than expected inflation prints we had last week, both for consumer prices and wholesale factory, the producer price index?
Yeah, we do think the Fed will cut rates around once by the end of the year and then once more at the beginning of next year. So that's, again, what the market is pricing, which is for one hike by March of 2027. I mean, look, we think that Bush is likely to be looking through this current energy shock, and the closer we get to the midterm elections, the closer we get to the anniversary of the start of the conflict, then obviously those inflation numbers do start to wash out of the numbers. They're going to be a bit concerned about some second order effects. But again, this is a much more narrow shock in our view than what we saw in 2022, when you had a combination of an energy shock and the supply chain shocks from the pandemic. So we don't think there's going to be as much pass through into broader inflation, even if this energy shock is strong. So we think the Fed is likely to look through it. As we go later into the year, then they need to be thinking about the labour market as well. And although the last couple of prints have been decent, over the past 12 months, there's been next to no jobs growth in the US. We think that is going to be of some concern. So look, bond markets do tend to test new Fed chairs. That's probably going to happen again in the next few weeks. But we think that by the time we get to the end of the year, then the Fed will be in a place to cut interest rates.
OK, Kieran, thank you very much. We've got your thoughts on so many different things. Thanks for answering all of our questions. Kieran Ganesh, multi-asset strategist at UBS GWM. Coming up on the show, well, it's finance ministers fighting for the UK top job and fuel, because G7 finance ministers meet in Paris with economic fallout from the war in the Middle East high on the agenda. We'll discuss more about that next. Plus, Greater Manchester Mayor Andy Burnham clears a key hurdle in his attempt to return to Parliament and potentially challenge Prime Minister Keir Starmer for the party's leadership. We'll bring you the latest this hour. Don't miss this, our interview with Jeff Curry, the executive co-chairman of AVAX Commodity Exchange and former global head of commodities research at Goldman Sachs. He will join us right here in the studio to discuss the outlook for the oil market. That's at 9:30 London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Well, it was one of the most hotly anticipated events so far this year, that Trump-Xi summit. And what was the fallout? Well, the White House says China has agreed to restore market access for US beef and resume imports of poultry from some states. According to a fact sheet published by the White House, China will buy at least $17 billion per year of US agri-products in the next 3 years. Beijing did not immediately confirm the announcements, but China's Ministry of Commerce said over the weekend it would work with the US to resolve or make progress towards resolving non-tariff barriers. The Russian President Vladimir Putin is heading to China this week, a few days after President Trump's visit. The Kremlin said that Putin and Xi will discuss their strategic, economic and trade cooperation.
We are closely watching global bond yields this morning. We always do, actually. As G7 finance ministers meet in Paris, economic fallout from the conflict in the Middle East is putting pressure on borrowing costs, which is of particular concern to G7 member Japan. Meanwhile, I thought it was to the UK and everyone, actually, you could probably argue. Meanwhile, French Finance Minister Roland Lescure said he hoped the meeting would offer an opportunity for frank dialogue amongst allies as the ties with Washington come under strain. Oh, Charlotte, I guess there's 6 of them, just kind of trying to find out what Scott Bessent has in his mind and what the administration's doing next, because They've all got similar problems: ageing demographics, far too high debt to GDP, fiscal deficit problems as well. But the problem is they're not all waging a war. And I guess until we know what's going on with the war, then really we can't make a lot of progress on other stuff.
Yes, absolutely. Like the goal of the G7 is to discuss what could be a risk to the prosperity of these economies, where the very concrete risk to this prosperity at the moment, of course, is the war in Iran. And again, a platform used to be a G6 at the time was to discuss the oil shock impact of the 1970s and how these economies could coordinate and can try to mitigate some of this impact. But fast forward 51 years, we are in a very similar situation because of the war in Iran and the Strait of Hormuz being basically shut down. Of course, this stagflation fears they're very, very clear for all these ministers that are just arriving behind me on this red carpet here in Paris. This is the 7th meeting that Roland Lescure, the French finance minister, has been chairing since January in multiple meetings because of these concerns around the war in Iran in particular. You remember back in March, in coordination with the IEA, they released a record amount of oil from strategic reserves thanks to the coordination of the G7. So they're discussing all this. But that comes, of course, after the warning from the IEA just last week, talking about how inventories are depleting at record speed and that the price spike in energy prices is yet to come. So that's an extra concern there for all these finance ministers and central bank governors, and investors looking more and more how rate hikes might come sooner rather than later, but to not be too trigger happy there as well. So this balancing act that they're working on here when they will be meeting elsewhere, where of course they will talk about Ukraine because higher oil prices, of course, is benefiting Russia. So the Ukraine finance minister will be attending the meeting here today, and also these G7 economies on how they can support Ukraine going forward. Elsewhere, again, other topics will be supply chain, of course, how to make them more resilient and less dependent on China and on rare earth from China and those critical minerals. So that's one of the key discussion, as well as global imbalances. Now, tomorrow there'll be some guest countries attending here, including South Korea, India, Brazil, and Kenya on top of the G7 ministers attending tomorrow to discuss more broadly how all these key economies can coordinate their action. But here again, the bond sell-off being one of the key topic that will be in discussion among those central bank governors and finance ministers here in Paris this first day of this G7 meeting.
Lovely work, Charlotte. I look forward to seeing more of your coverage. Thank you. Right, the Ryanair CFO Neil Sorahan says airlines could fail this winter. I don't think he means Ryanair, he means the others. This, as the company said, it doesn't see any fuel supply issues over the summer. I'm going to say that again because it's actually a rare spark of good news, isn't it? Neil Sorahan says he does not see any fuel supply issues over the summer and that it is increasingly confident it won't be an issue beyond that time. That's bullish, isn't it, compared to a lot of what we've been hearing about jet fuel. Nonetheless, though, the airline says it's too early to provide any meaningful profit guidance for 2027 at this time. Well, the CFO, Neil Sorahan, told our very own Ritika he's less concerned now than he previously was.
Our contingency plan this year is that we're going to carry 216 million passengers, 4% increase. We're not planning for cancellations. Do we have plans for some kind of an Armageddon situation? Of course we do, but I don't see that coming to pass. As things stand, we're operating a full schedule this summer, plan to operate a full schedule into the winter period, which will see us grow by 4%. And as I said, carry 216 million passengers, start taking in our MAX 10 aircraft in the spring of next year. So I'm less concerned than I was. That said, who knows what may or may not happen. But based on what we're seeing at the moment, we're very happy to keep things as is.
Well, the price of jet fuel has nearly doubled since the start of the Iran war, as the closure of the Strait of Hormuz, the effective closure, restricts supplies from key exporters. With the crucial summer holiday season ahead and the strait remaining shut, there are fears of shortages of jet fuel, with airlines already altering schedules to try to combat any potential problems. Heading skyward, aircraft across the globe, and also the price of jet fuel, a crucial cost in air travel. The International Energy Agency is warning that Europe could face physical shortages of jet fuel by mid-June. Deliveries from the Middle East, that normally account for 60% of Europe's jet fuel imports, have been cut off. The pain is already being felt. Lufthansa's cancelled 20,000 short-haul flights, while other airlines, including KLM and Scandinavian Airlines, have also reduced their schedules. And it's left airlines facing a turbulent summer holiday season. And here's the problem. Since the Iran war closed the Strait of Hormuz, the price of jet fuel has soared from around $100 a barrel to more than $200 in March and April, though it has since fallen back a bit. With fuel making up 25 to 30% of airline operating costs, according to IATA, that price spike eats into profits. Most European carriers hedge up to 80% of their fuel needs for the months ahead, so the summer holiday season should, in theory, be covered. But what if there's an actual physical shortage of jet fuel?
As long as nothing alters the flows of the supplies coming from West Africa, America and Norway into Europe. Most of what comes through the Gulf is going to Asia, but obviously we want to see the Straits of Hormuz reopen as quickly as possible.
Others point out that East Asian refineries rely on imports of crude oil from the Middle East, without which they cannot produce jet fuel either. The UK government has asked Britain's remaining 4 refineries to maximise jet fuel production to try to avoid shortages here.
Jet fuel inventory is really very low at all times. We barely store jet. It's a premium fuel, it's difficult to make, and it doesn't store well. So I thought we would be in a more of a crisis situation with jet fuel in Europe than we've seen as of yet. And that's been interesting that they're managing. The oil industry, as you know, is extremely flexible. And when prices get crazy, the solutions are found. One of the wildcards has actually been Nigeria performing well in refining and sending jet fuel into Europe. But again, it's hard to see how you can continue with this kind of shortage for another 2 or 3 months. It's going to become a problem eventually.
Europe is importing more jet fuel from the US, but the IEA says that would only replace around half the lost supply from the Middle East. Capacity is limited as not all US refineries can produce the grade of jet fuel used in Europe, which is different from the type used in America. Even if airlines are striking a confident tone about bookings and customer demand, inflationary pressures on household and business spending could lead to a delayed effect on air travel, with fares already rising, especially on long-haul routes.
It's kind of the Wile E. Coyote moment, where it goes over the cliff, sees nothing below him, and then falls down. We're at sort of step 2 of this journey. Consumers so far is continuing to spend on travel, but when you start feeling it at the grocery store, at the petrol pump, if inflation starts rising, if rates start going up, does the consumer keep spending, or does more capacity need to come out of the market?
Ben Boulos, CNBC. And that point that Alexander made there towards the end is a really pertinent one, because yes, as I mentioned, we're seeing some fares on long-haul flights go up, fuel surcharges and the like, schedules being shut. But I did a search for a short-haul flight in June in Europe, popular Spanish destination. The price had come down significantly. I was able to get a basic fare for £22. That when I'd looked originally, it was 2 or 3 times that.
£22?
£22.
Where are you going, Magaluf?
No.
Torremolinos?
No. Barcelona.
Look at you.
And £22 fares. I haven't seen that for a long time. When I originally looked, they were up around the kind of what you'd expect, 70, 80, 90. But I think what we're seeing there is airlines trying to kind of stave off people's fears and the potential demand destruction that may come about when people look at the headlines.
You're quite smug, aren't you?
I'm sharing some useful
22
advice.
Quid to buy.
I'm sharing some useful advice.
I too have been looking for a flight to a Spanish destination for a little bit later in the year.
Magaluf? Torremolinos?
Touche. No.
Touche? No, that's in France.
No, that's Le Touquet. Le Touche. No, you're very good. No, it was Valencia.
Oh, yeah, very nice.
Yeah, 350 quid. And I've got to take the wife. 700 quid.
Wow.
Yeah.
Okay.
So you were your 22 quid flights, young man.
But I think this is the thing. That's what you'd expect. I would have been more expecting to see what you found.
Yeah.
You know, the price is jumping. But I think what they're so worried about is people holding back, because this is the season where they really need to make their money.
Mine is two forces colliding. A load of idiot runners going for a race in Valencia. You see, that's the problem.
Oh, is this the Valencia Marathon? Half. Yeah. It all counts.